My special guest today is Stuart Kruse. He's a certified financial analyst and CEO for Kruse Asset Management. What's your subject we want to talk about today?
Well, I'm going to talk about something that I don't think a lot of retail investors know about, and it's an asset class called structured products. And they've been a little bit, I'll say, kind of put on the back burner for a while, but there's a very popular Chicago company that's kind of turning that around and making structured products more accessible to the everyday person.
Wow, wonderful.
So let me explain a little bit what a structured product is, and then we can kind of take it from there. So a structured product is, what the name would be implied, is a structured income that has an underlying investment. So for example, it's a CD or a bond that instead of you paying interest like you would get at the bank, it pays you based off of an underlying asset, which could be an index like the S&P 500. It could be gold. It could be a basket of stocks. It could be anything you want. It's structured to give you a particular payout. So for example, a very bare bones basic structured product might be something that is principally protected. So in order to walk you through this, like a CD, it will have a maturity. And let's just say the structured product is a 5-year maturity. And if you were to go to a bank and get a CD, maybe you'd get a couple percent for that CD. But if this structured product was linked to the S&P 500 and it were principally protected, what happens is in 5 years, you look at how the S&P is done. If the S&P is up, you get the returns of the S&P, or sometimes actually even a little bit more. If the S&P is down, which it's down about 20% of the time in any 5-year window, your principal is protected, so you get your money back. So it's a way to participate in the upside of the market and not take any risk.
Okay.
So it's a very bare bones basic version. Now, a structured product term is a catch-all for all sorts of different structures. So that one was principally protected. You could have things with just some protection, maybe 10, 15, 20% protection to the downside. You can actually have capped upsides, but accelerated returns. They get all sorts of complicated. So you generally, the reason why they weren't very popular or haven't been very popular in the retail market is because they're hard to analyze sometimes. They get to be complicated. And frankly, a lot of retail advisors don't either have the patience or the tools to analyze these structured products. But it's a $4 trillion marketplace. They're mostly used by institutional level investors who have the capabilities and the technologies to analyze these products. Now, Kruse Asset Management, we're a quantitative investment firm, so we're comfortable with the analytics, but we've partnered with a company called Halo Investments, which is out of Chicago, and their goal and their mission is to democratize structured products for the retail investor. So we can create our own structured products on the fly using artificial intelligence and bid them out to the banks. So it's a great asset class to help reduce risk for people that maybe don't want the risk, but also want the upside reward.
I was going to ask a question here. Would you say sort of comparable to the index product?
You mean like an index variable annuity?
Yeah, index annuity or index, any kind of index product.
Yeah, so typically an index annuity or some sort of index product will give you a lesser version of that return. So for example, if it's indexed to the S&P 500, you might get a percentage, 60%, 80%, 50% of that S&P. For structured products, you usually get actually a leveraged upside. So for example, we just created a product that we put all our clients in that had 30% downside protection. Now, keep in mind, the S&P in a 5-year window has only been down one time more than 30% over the last 50 years. So the odds of this negative occurrence happening are really small, but on the upside, you had leverage return of 118%. So you actually got a greater upside return than you would had you just invested in the S&P, where these index products tend to be indexed and get you a fraction of the return, half of that return.
Wow, that's a big difference.
Huge difference, and compounded. And so compounded over your life, what you want to do is you want to take calculated bets. Like if you said, I wanted to put $100,000 to work, I wouldn't suggest you taking $100,000 and putting it all in one structured product we create. you would want to ladder those in with the odds in your favor. So 10,000, 10,000, 10,000 perhaps. So it's a little bit like going to Las Vegas and saying, hey, I am the house. Does the house want to play just one hand, or does it want to play a bunch of hands with the odds in its favor? Well, it wants to play a bunch of hands with the odds in its favor because it can lose any one hand. But if you have the odds on your side, the more hands you play, the more of a mathematical certainty it is that you're going to win.
Exactly. Yes. Yes. What it sounds like is it's not as risky as it appears, though. Well,
yeah, I mean, that's the whole point of these structured products is they are there to eliminate or reduce the risk. And as you ladder them in, you're further reducing more and more risk. So they become a little more complex to analyze. But again, with the help of Halo and some other analytical companies, they're becoming much more easy to access and understand. So for example, as I said, you can structure any product you want. We created an income note recently. Whether you like this or not, this is just an example of what we can do. We created an income note with the underlying is Tesla stock, which sounds extremely risky for some of my clients. And I wouldn't buy Tesla stock for a lot of my clients because of the volatility. I'm not saying anything about Tesla as a company, just the stock volatility is not appropriate for everybody. But this income note, it's an income note and it's predicated on paying interest as long as Tesla stock has not dropped by 50% from the point of its strike price. Now, I'm not saying Tesla can't drop by 50. It certainly could, but it has never, ever dropped by 50%. So I would say the odds are in your favor that it won't drop by 50% in this one print. And in the meantime, for as long as Tesla has not dropped by 50%, if it dropped 30, 40, 28, went up 20%, our clients get a 20% annualized return, a coupon of 1.66% paid every single month. So maybe that bet's good for you, maybe it's not, but it's a way to reduce risk, take an income in a very low interest rate environment, and place bets on companies and stocks that you think are solid, but that, and through the analytics, you can look at to see whether these things have occurred or how often they have occurred. In the Tesla case, it's never occurred. So that's a small bet I might want to take for some of my clients to earn 20% on their money.
20% is a marvelous return of money.
Yeah.
Not only that, but having to know that it's not as risky as it appears.
Right. Exactly right.
With most retail investors, retail and financial advisors, they don't understand that.
Quite often most retail advisors will outsource the money management part. And so they don't really have as much incentive and or interest to basically do the analytics. They will use ETFs or mutual funds, and they might put together some asset allocation plan, but the actual analysis part is usually not their forte. They're into the relationships, which is great. And you have to have a great, solid, trusting relationship with your advisor. But a lot of advisors will farm that part out. And so some will, take the time and to analyze some of these structures that are available to them, then they can add value to their clients.
I think that probably more of the independent financial advisors are more open and receptive.
Yeah.
I think more that are in a house, the house advisors for the big wirehouses, maybe not be as open.
It might not even be because the advisor themselves are not open. It may be because of their compliance department wouldn't allow them to be open. So for example, a very large firm here in Chicago, William Blair, this is my understanding that William Blair all their advisors were not allowed to use structured products at all because of the difficulty in advising clients on these structured products. And so if you think it from a compliance standpoint, they have to make sure all of their advisors have the tools and capabilities to be able to analyze these products so that they can protect all of their clients. And so they just made a blanket statement that you just can't use them. Now, since then, this is again a commercial for Halo Investments here in Chicago. Halo has partnered up with William Blair, and because of their analytical tools, they're now allowing those advisors to use structured products. But this is just one example of a capability of a larger bank just making a whole, across the board decision saying you're just not allowed to use them at all because of a compliance reason.
Wow. I like the idea of having Halo.
Yeah, it's great. I mean, I will tell you, I would buy, let's say, a JP Morgan structure. And by the way, people have never heard of these things, but JP Morgan, Citibank, Goldman Sachs, Bank of America. They've been offering these structured products every single month for as long as I've been in business, and that's been well over several decades.
Yeah.
So they are out there for sure. It's not, these are not a new product at all. But let's say if I were to buy a JP Morgan product directly from JP Morgan,
Right.
I actually have to write a letter to my bond desk in order to get this transacted. And now Halo has made it so that I can go on their platform and just order it online, more or less. Very similar to how Amazon makes purchases more easy for everything else. So like when I want to go buy a volleyball, I don't go to Dick's Sporting Goods because it's too much of a hassle. I just order it from Amazon. It's the same thing for structured products now. Instead of me going directly to JP Morgan to get my structured products or Bank of America or Citibank, I go through Halo platform and they will give me the analytics and tools and give me the best price for my clients.